Most people believe the path to financial freedom is simple. Work harder, earn more money, improve your lifestyle. But for millions of people, something strange happens. Their income rises every year, yet financial stress never disappears. Bills increase, obligations grow, pressure builds. Instead of feeling wealthier, they feel trapped. This is known as the money trap, a system where higher income does not lead to freedom, but to deeper financial dependence. At the beginning of a career, income is limited. People live modestly, small apartments, basic transportation, minimal expenses. Because income is low, spending is naturally controlled. But as income grows, expectations begin to change. A promotion leads to a better apartment. A higher salary leads to a newer car. A bonus leads to lifestyle upgrades. At first, these decisions feel logical. After all, working harder should improve your quality of life. But this is where the trap begins. Instead of increasing financial security, lifestyle expands alongside income. Economists call this lifestyle inflation. As earnings grow, spending grows as well. The financial baseline keeps rising. So even though income increases, the feeling of financial pressure remains. The system quietly resets the starting point. Imagine someone earning $50,000 per year. Their living expenses may be modest, but if that person begins earning $100,000, something predictable happens. Housing improves, transportation improves, daily spending increases, more services are added, streaming subscriptions, gym memberships, new electronics. None of these expenses seem extreme individually, but together they create a much larger monthly obligation. Soon, the person who once lived comfortably on $50,000 now feels pressure even at $100,000. Income doubled, but financial freedom did not, because expenses expanded with it. The money trap becomes stronger when debt enters the system. Modern financial systems make borrowing extremely easy. Credit cards allow instant spending. Car loans allow immediate upgrades. Mortgages allow people to buy homes far larger than they could pay for with cash. Each of these decisions creates a long-term payment obligation. Monthly payments slowly accumulate. Credit card payments, car loan payments, mortgage payments, student loan payments. Eventually, a large portion of income becomes permanently committed to future payments. Instead of income creating flexibility, it creates responsibility. This is when people begin to feel financially locked in. They cannot easily change careers. They cannot easily reduce working hours, because their entire lifestyle depends on maintaining a specific income level. One of the biggest misunderstandings in personal finance is the difference between income and wealth. Income is money that flows into your life through work. Wealth is money that remains and grows over time. Someone earning a large salary may appear financially successful, but if all of that income is consumed by lifestyle and debt, little wealth is actually created. On the other hand, someone with moderate income who consistently invests in productive assets may slowly accumulate real wealth. This difference becomes clear over long periods of time. Income supports lifestyle. Assets build independence. Assets are things that produce value over time. Stocks, businesses, real estate, productive investments. When assets generate income, financial pressure begins to decrease because money is no longer coming only from labor. Instead, capital begins working alongside effort. This changes the structure of financial life. Labor income becomes optional rather than mandatory. But most people never reach this stage because they remain trapped in the consumption cycle. Every increase in income is absorbed by new expenses. Instead of acquiring assets, they upgrade their lifestyle. The system keeps resetting itself. The money trap is not only financial, it is also psychological. Modern culture constantly promotes consumption. Advertisements encourage people to upgrade everything: phones, cars, clothing, homes. The message is always the same: a better life requires more spending. But the reality is different. In many cases, higher consumption simply increases long-term financial pressure. The more complex a lifestyle becomes, the more income is required to maintain it. Freedom becomes harder to achieve. Escaping the money trap does not require extreme income. It requires a different financial structure. Instead of allowing lifestyle to grow with income, a portion of income must be redirected toward asset creation, investments, ownership, productive capital. Over time, these assets begin to generate value, and as that value grows, dependence on active labor slowly decreases. The goal is not simply earning more money. The goal is building systems where money continues to work even when you are not actively working. The money trap is not caused by low income. It is caused by a financial structure where lifestyle grows faster than wealth. Higher income without asset creation only increases the size of the financial cage. True financial independence begins when income is no longer the only source of stability, when assets start producing value, when expenses stop expanding endlessly. Understanding this structure changes how money is used, not just to live better today, but to build freedom over time.